Hello, in this video, we'll talk about the introduction to corporate tax. Now, we're really referring to the corporate income tax, and we're going to talk about some basic items with respect to the background of the corporate tax. This video is not meant to go into advanced issues regarding corporate tax. There's other videos out there that deal with various advanced issues like corporate formation, distributions, and dividends, as well as redemptions, liquidations, stock dividends, all those different things. This video is just meant to be a broad overview for anyone that's interested in learning about the corporate tax and how it fits into our income tax system. There's really 6 different topics that we're going to discuss in this video. The first is the corporate tax history and rates. And you're going to see some very interesting facts, mainly looking at the corporate tax rate over time as well as the individual tax rates over time. The second thing we're going to talk about is the corporate tax in the sense that it is a separate tax, which will lead us to our third discussion, which is the phrase that many people think about when they think about corporations is double taxation. We're going to talk about the double tax regime. Fourth, we're going to talk about the effect with respect to taxes on corporations from the Tax Cuts and Jobs Act of 2017, because that had a huge change to the corporate tax landscape. The fifth thing is talking about how do we classify an arrangement. An arrangement in the sense that an arrangement can be viewed as a business, and if it's viewed as a business, will it be considered a partnership, a corporation, or neither for tax purposes? And finally, the sixth topic in this video will be the calculation of the corporate income tax from a broad overview, and we're going to mainly look at it from the sense of looking at the individual income tax and what we normally think of when we think of our income tax system and how it actually fits in this, the formula, what's in there, what's not, and what areas of the Internal Revenue Code specifically apply to corporations versus what areas deal specifically with individuals and where there's some overlap. So I really hope that you enjoy this video, and let's go through these topics. All right, so let's talk about history. Talk about the corporate tax, the history of the corporate tax. We're going to talk a little bit about individual tax and how that plays in, because later on in this discussion, it's going to be important to look at how the corporate tax rates affected and the history over time, as well as the individual, especially the ordinary income tax rates over time. Now, a lot of people don't know, but the corporate tax actually has pretty much outlived our current U.S. income tax that came from the 16th Amendment, which allowed Congress to actually levy an income tax. In 1909, there was actually an act that allowed for a corporate tax. It was viewed as a corporate excise tax, but really it just continued on to become the corporate tax. There was a special act that was actually allowed it, and there was a 1% tax basically on net income with respect to over a certain amount of exemption amount. And that's really the start of our corporate tax, and it's really continued to this day, and that was in 1909. I'm really going to focus on 1913 because that's when officially the income tax came about, and that way we can compare to the individual income tax, which has been around since 1913. So first thing I want to do is I want to focus on the corporate tax rates, and we're looking at the highest corporate tax rate out there. Now, one thing to note is that in corporations, there is no distinction in rates between capital gains or preferential items and ordinary. Corporate tax taxes everything the same in terms of the rate. So we're looking at the highest marginal rate. We're not looking at effective rates. We're looking at the highest marginal rate based on the period of time from 1913 until 2018. I'm even going to go into the future. So this video is in 2018, and if you're watching this in the future, it still can help you because it provides over time and it shows. And I'm going to focus in on a few key dates going along this timeline, because there are some dates that really show you how things change. So you see our little our table here. We have the percentage, the tax rate percentage here on the left, and then we have on the horizontal axis, so the vertical axis is our tax rate percentage. Our horizontal axis will be the years. So we're starting around 1910, which we'll just say 1913. Then we'll have 1920, 30, 40, 50, 60, and then we get to 2000, 2010, 2018, where we're at today. All right. So when we started the corporate tax, it was around a 1% tax, 1% on the net income of the actual corporation. all right, which has evolved over time to be taxable income, right? And we subtract away credits and whatnot. Well, we had World War I, and some of you might be thinking, okay, well, corporate tax actually might have skyrocketed during World War I. Actually, not the case. Corporate tax rates didn't really rise that much. In 1920, corporate tax rates were around 10%. So I have this timeline here. And by the way, this graph is not, by year. I'm just doing it by special dates within and the 10-year marks. So there might have been some fluctuation between these decades I'm not referring to. So, it's not 100% accurate, but it does give you a good estimate. And I've looked over it, and it is pretty close to the actual, if you look at year by year, the rates. So we start off, again, 1913, we're about 1%, and we go up to about 10%. All right, so we're at 10%. And things continually pretty much stay around about the same in the 20s. And in 1930, we're at 12%. So we're still very low in terms of where we're going to end up. We're at a 12% rate in 1930. All right, well, we have the recession. The stock market crashes. We have the big recession. And we have New Deal and whatnot legislation. In 1940, the corporate tax rate doubles to roughly 24%. So now we're about 24%, and now we're starting to get closer to, some of the corporate tax rates that you might recall. So that's in 1940. But what happens in between 1940 and 1950? We have World War II, which the U.S. was heavily involved in, and corporate tax rates, they skyrocket in terms, if you look at 1945, corporate tax rate went up to 40%. So it went all the way up to 40%. But after the war is over, in 1950, corporate tax rates go down to roughly 30%. So they go down a little bit. So they didn't just stay the same after World War II. They actually did go down a bit. So what happens between 1950 and 1960? We have the Internal Revenue Code of 1954, where there was a change in the policy and ideological views of a lot of what tax is meant to do. So in 1960, the corporate tax rate is the highest that it's ever been at 52%. 52% tax rate. So we go from the 30% in 1950 all the way up in 1960 to 52%. So the corporate tax rate is at 52%. And that's just the federal tax rate. You also have to factor in states and other localities, right? Other jurisdictions. This is just the federal rate. So 1960, we're at 52%. 1970, we're at 48%. So we're roughly between 1960 and 1970, we stay pretty much around 50%. We're pretty close to that number. But we do go down a little bit. Again, 1970, we're at 48%. Between 1970 and 1980, we still stay about the same. We're very close to that 50% mark. We, in 1980, are at 46%. So we go down just a little bit to 46%. All right, so what happens between 1980 and 1990? We have major tax legislation, reform, and we have the 1986 tax code. And tax rates go from 46% in 1980, and they drop down dramatically to, in 1987, 1988, after the tax law changes, they drop down to about 35%, 34, 35%. We have this cliff right here, drops down. And tax rates remain at 34% in 1990 as well, so they stay about the same. And then after 1990, they go up a little bit to about 35%. So we're pretty much staying, so from 2000 until 2018, the corporate tax rate remains the same at 35%. 2017, sorry. 2018, it drops dramatically down to 21%. And this is a permanent provision, as of the Tax Cuts and Jobs Act of 2017. So it looks like going in the future that this amount will continually stay at 21%. But that's for, again, this video is in 2018, so we'll see what exactly happens. So that's really our rate structure. Only part of the time has it gone above 50%. But I want you to pay attention to something. Between World War I and the codification of the new tax code in 1986, right? 1986 Internal Revenue Code, tax rates were roughly between around 40 to 50% during that time. That's 40 to 50% during this time. So let's bring attention to this. Roughly between 40 to 50%, because that's going to be really important for a later discussion. Keep that in mind. So let's take a look at the individual rates. Specifically, we're talking about ordinary income. So capital gains historically have been taxed much lower than ordinary income tax when it comes to individuals. And this is how very wealthy people got away from paying huge levels of tax, especially when you're looking back in the 40s and 50s, 60s, and 70s, which I'm about to demonstrate. Because you might be wondering, well, if some people are subject to a 94% tax rate, well, how exactly did they keep their millions of dollars? Because most of the wealthy people, they were able to categorize that as capital gains, which historically, capital gains have had a tax rate around 28%. And that's for individuals, because remember, corporations do not get that preferential rate. You do have to characterize as capital, just like for an individual, but that's only because of the limitations on capital losses and capital gains and whatnot. But individuals, historically, the capital gains rate averages around 28%. And that's for the whole life, the whole century or so of income taxes, individual income taxes we've seen. So let's go ahead and talk about the history of the individual income tax, because again, it's going to be helpful to understanding the corporate tax history and later on understanding the benefits of why corporations were used with respect to taxes. So we start in 1913, we have the 16th Amendment, and we have our income tax. Now there was tax before, but this is really where I want to focus, because this is our current income tax system. It's been rolling since then. And the income tax rate started at 7%. This is the highest ordinary income rate we're talking about, 7%. All right. So again, I'm going to be focusing on some dates here. Not only, we're going to be doing the decades, but this isn't an actual graph, but it's pretty close because I'm focusing on the decades. And it's also, I'm going to focus on some dates between those decades. But it's pretty close. All right. So 1913, we're at 7%. Well, what happens between 1910 and 1920? We have World War I. So World War I happens. And then guess what? In 1920, the tax rate is around 73% is the highest rate. It's around there, between 70 and 75%. So we jump, just in that decade alone, all the way up here to around 73% in that time period towards the end of 1920. All right. Now, once World War I, we've paid off, our whatnot, from taxes, what we owe, that really clears. Then between 1920 and 1930, taxes start to drop. And in 1930, the tax rate goes down to around 25%. So this slowly, and again, this isn't 100% accurate in terms of the actual years. And again, this isn't 100% accurate, but it's pretty close. But we drop down from around 73, 75% down to 25%, just like that. All right. So we stay around 25%, and then we have the New Deal between 1930 and 1940. And at the end of 1940, the highest corporate tax rate is around 79%. It jumps up. So so far, we're on the trend here. Okay. And by the way, in 1940, U.S. has not entered World War II yet, so that is not a concern, because you're going to see what happens when World War II comes around. All right, so far we have these spikes, right? Gone up, gone down, gone up, right? Well, what happens in between 1940 and 1950? We have World War II. So around 1945, we have our highest tax rate ever in our history up to 2018, up to this date, and we have a tax rate, believe it or not, of 94%. Almost 100%. Now, this is, at this point, there's a lot of different brackets. When at the time of this video, it's only 7 different brackets. Back at that point, there was 20 to 30 brackets you're talking about. So depending on what you made, you weren't taxed at 94% on everything you made. That we did have the marginal system, our progressive system. All right. Now 1950, we do go down a little bit to around just above 80%. just above 80%. Can you believe that? So we're still really high. Between 1950 and 1960, we go up to around 91%. All right? That 91% remains till around the late 60s, and then slowly in 1970, we go down to around 70%. So during this time period, from World War II until about mid-1960s, we have tax brackets in the 90s, in the 90 percentile, 90%. That's crazy, right? Again, a lot of the wealthy people, though, had the capital gains. That's how they got away with it. Now, between 1970 and pretty much the codification of the Internal Revenue Code 1986, we pretty much stay the same around the 60 to 80% tax, the highest tax rate. So around 70%. And then what happens? We have our tax code of 1986, and our highest tax rate in 1987, 1988 was 28%. And that was actually a time that had the lowest, we only had two tax brackets actually, 15 and 28%. And then in the mid-90s, we go back up, but not as high as it ever was, just to around 40%. So in the late 90s, we pretty much stay the same around the 40% is the highest bracket. And then in the early 2000s, our highest tax bracket drops down to about 35%, which that stays the same until about 2010. And late 2000s. In the late 2000s, it goes back up to about 40%. And then that stays the same until in 2018, we have a tax with the Tax Cuts and Jobs Act of 2017, the highest tax rate drops down to 37%. And that is viewed as continuing on into the future. Look at this graph. We have the corporate tax rate, which you can see has gone up and it's gone down. But look at this. We have a lot more cliffs going up and going down. And again, there's a lot of dates to focus in on. Obviously, World War II is a big date. World War I, 1954 with the second codification of Internal Revenue Code. And you'll notice that this area pretty much stays very high. And that was because with the codification of the 1954 Internal Revenue Code, our tax policy changed to be a lot more redistribution focused. And then when we have the 1986 tax code, where it drops down dramatically to around 28%, we have a change in terms of moving from redistribution as the main focus of our tax system to more of raising revenue. And you'll notice this is with the corporate tax, though, it's kind of stayed very a lot more stagnant. Now focus in on, again, World War II until the codification in 1986. We're talking anywhere, the tax rates were probably from anywhere to 70 to 90%. So if you have some type of business that has ordinary income, like a sole proprietorship or partnership, and you potentially can be taxed at 70 to 90%, why not operate through a corporation where you can reduce your taxes by half? Now, we're going to talk about double taxation in a moment, but it's possible that you can conduct business through a corporation during these years, and you can save yourself, 30, 40, 50% in taxes based on the year. So that's a big deal because you can keep the money in the corporation, and there might be various ways to actually get to those distributions without paying tax. So that's really the history of the corporate tax, and it's a very interesting history, and it's really important to focus on this key difference about the highest rates, and because that's going to be focused on in the next items, the next topics. So the next item, we're going to talk about how the corporate tax is a separate tax. It's separate from the normal income tax that taxpayers pay, but other types of business entities, such as partnerships and sole proprietorships, how they don't have a separate tax and why exactly that is. We're not going to go into too much or any advanced concepts. We're just going to talk about this generally. So you might recall from a business law class or some type of other legal based class that you've had, a corporation is a separate legal entity. It's a separate legal entity. The owners of the corporation are actually separate from the entity itself. And this is a huge part of why the corporate tax is computed at the corporate level and then the owners themselves have their own tax system. That's the idea, is that a corporation is, think of it as basically another being. It's not a human being, but it's another being. It has a birth certificate, right? The articles of incorporation, the bylaws, the charter of the state, all those things, that makes it, that's like the birth certificate. It's an actual individual with respect, it has rights and whatnot under the state. So there's a lot of policy issues out there, whether a corporation should be taxed separately from its owners or should be taxed just as the owners, just like, for example, a partnership. Now, there's other videos that I have that deal with tax policy, but I just want to talk about, the 3 pillars. So whenever we talk about tax policy, you always have to consider 3 elements. There's always 3 elements to consider. The first element is simplicity. The second element is equity or fairness. And the third element is what we call efficiency, and that's more of the economic side, which there's a lot of elements to efficiency, but the biggest thing is, do we want to disincentivize or incentivize taxpayers from doing certain behavior? All right, so let's just take a look generally at these 3 pillars. And again, this is not meant to be an advanced discussion of why or how, or whether yes or no we should have a separate corporate tax. But there, right now, at the time of this video, there is a separate corporate tax. So there's just some general ideas to think about. When it comes to simplicity, we're talking about simplicity on behalf of the taxpayer in terms of filing, as well as the government through the IRS in terms of the level of administration. Now, one thing is that a corporation must maintain its own records and have a type of accounting and all that stuff because it is a separate entity under state law. So from a simplicity standpoint, the corporation actually filing taxes and administering it isn't really that big of an issue. So, I mean, there's arguments that you can make that simplicity is an issue, but overall, simplicity is not an issue when it comes to having a separate corporate tax. Actually, there's issues where, okay, well, if we have 1,000 different owners and we didn't have a corporate tax, and you had each owner is on different types of has different tax years. How would you deal with all that from an administration standpoint, especially with respect to the IRS? That's a huge issue. So having the corporate tax actually does provide simplicity, at least on the IRS's end, when it comes to things like accounting method and accounting period. Those are just some examples. Equity, fairness. So this is a huge element because when you look at, let's say, a partnership for tax purposes does not have a separate level of taxation. It flows through, just like a sole proprietorship, to the owners. But there is, when you look at partnership tax, and I have some videos on that, there are some competing themes. We call it aggregate versus entity theme. Aggregate being saying the partnership, for tax purposes, is just an aggregate of the owners, so everything should just flow over, and that's usually shown through what we call separately stated items. That's a perfect example of that. Versus entity, for example, a partnership under the partnership tax rules is required to have a year end that's a single year end for the partnership. So again, we don't have that issue that we talk about simplicity that the corporate tax avoids. Okay, when you have all those shareholders. So from an equity standpoint, is it fair to have one level of taxation for somebody that is doing business through a partnership versus a corporation? Is it fair, that they get hit with, or they have another tax and then they have a tax on that, which we're going to talk about. That's one issue when it comes to equity. We should always consider that, and that's a very good point. It's very questionable, and that's just something that over the years that Congress has tried to, and the courts and at Treasury, they have tried to deal with that issue in various ways. Now, I will tell you that when you look at the specific application of the tax law, there's a lot of provisions that do take into account equity issues and whatnot. They're trying to, like, for example, dividend received deduction is a perfect example of, it has equity and efficiency elements. What it is if you are a corporate owner and you own shares in another corporation and you receive dividends, not only are you going to get double taxation, could be triple, quadruple, depending on how many layers of corporations there are with the dividends. So the DRD tries to avoid anything more than double taxation, because that's what it tries to do. It looks at your ownership percentage and it gives you an exclusion of having to pay tax on that dividend. That second level of taxation we're going to talk about in a few moments. But the issue is, is it fair to have that many levels of tax? Because at a certain point, you wouldn't actually get the benefit of any distribution when you have to pay 7, 8 levels of tax if you have that many levels of entity. So that's equity. And equity, we can talk about all different types of things, but there are some provisions. But overall, that answer has not really been, that's still something out there. Efficiency basically deals with, do we want to encourage or discourage the actual corporate form? And this is it's sometimes equity and efficiency kind of go together. What really we're talking about is, do we want to discourage it or encourage it or what? And the idea here is that overall, in our country, we do like to encourage corporate form. We do like to have, make sure that taxpayers can get limited liability. That's a big benefit for having the corporate form. When you look historically, is that corporations have limited liability. Do we want to encourage corporate form? And overall, if you look at the provisions of the various corporate tax provisions, which you can look through my videos, for example, corporate formation or various liquidation rules, redemptions, you can actually get special treatment, favorable treatment with respect to certain transactions. Perfect example is corporate formation. If you simply, let's say you own a sole proprietorship and you want to transfer all your assets, and let's say you don't have any liabilities, all your assets into a corporation that you form, which again is a separate legal entity, and you own it 100%, well, in that case, when you transfer your assets in exchange for stock, you will not have to pay tax. Let's say you have a gain. You won't have to pay tax on the gain. Now, it's deferred until the future, but you won't have to pay tax now, and that is an efficiency aspect with respect to looking at our corporate tax system. Now, what about the efficiency of having a separate corporate taxation? That's a fair question, and again, there's lots of questions out there. It's an interesting question. But again, the idea has to go with, it's all centered on our separate legal entity under state law. That's really the idea, is that when you look at a corporation, it is a separate legal entity, separate from its owners, and that's how the corporate tax law has really, it's focused on that element. That's the biggest element when it comes to all these things. So the next topic we're going to talk about is the double tax regime. Now, many of you, when you probably were thinking about corporate tax and corporations, the thing that most people know, even people that aren't even tax practitioners, know about corporate tax is the dreaded double tax. And whenever I think about double tax, I think like a horror movie, when you get to that scene where, the murderer is about to, jump out of the bushes and you hear, that's the double tax to me. So, and we're going to talk a little bit about, tax planning and the role of corporations over the years and how they've come and gone, and possibly how they might come back after the Tax Cuts and Jobs Act. But I want to just focus here on where exactly the double taxation actually takes place. If, for those of you out there, you might not know where it's at. Some of you are like, okay, well, I know exactly where the double tax is, but I just want to clear that up. So the first level of tax, and we just talked about how the corporate tax is a separate and distinct tax. So the corporate tax is separate. It's a separate tax. It's separate from the individual income tax, right? And that's going to be a factor even if you're talking about a partnership or another business entity or another corporation owning, because you're going to have different levels of tax. So separate tax. So the corporation itself, we're going to calculate some form of net income, taxable income. We're going to multiply that by a tax rate times a tax rate, right? And we're going to calculate the amount, our tax liability, and let's assume that we don't have any credits or there's no adjustments to be made, okay? So that's going to give us tax liability. That tax liability must be paid. So that's the first level of tax. That's level 1. So that's actually the normal operations. So the first level of tax is on the normal operations of the actual corporation. However, all corporations have owners. And when that net amount, that income after taxes, right? That income after taxes, income minus tax, is distributed to the owners. It's distributed to the owners. The owners, at the owner level, is where we find the second level of tax. At the owner level. And that can be, if a corporation owns another corporation, the corporation would have to pay tax because the dividends would come in, or the distribution, whatever it is. It can be property, cash, stock, is distributed. Property, cash, stock can be distributed, and other things as well, but property, cash, stock are the main things, distributed over, and that second level of tax, that's where it comes into play. So usually what we see, the most common that we think of when we think of double tax is, okay, we have a big corporation. Let's just say we have Walmart. Walmart's a corporation. Let's say that, okay, it makes $1 billion of income, and let's say the tax rate that year, just to keep it simple, is 30%. So on its taxable income, let's say taxable income of $1 billion that year, it's going to pay $300 million in taxes. Let's say there's $700 million left that Walmart can distribute, and it does distribute. Now, the owners get that distribution of cash, at $700 million. And let's say all the owners, for simplicity, I know this isn't realistic, but all the owners are individuals. When they get that $700 million in the form of a dividend, which if you watch my various corporate videos, it discusses how that actually is going to be treated. It could be taxed, might not be taxed, but let's just say it's a dividend, then it will be taxed to the owner. Could be taxed under preferential rates, or in the past, it wasn't taxed under preferential rates, and what would happen is it'd be taxed at ordinary rates. So usually what we see is dividends or other distributions, they are subject to the individual rates, whether they're ordinary or they're the preferential. That's where the second level of tax is. So that $700 million gets distributed. The owner gets that money. Let's say it's a dividend. It's subject to a preferential rate. Let's say the preferential rate for that person is 20%. Let's say they get $1 million in dividends. Well, they are going to be paying $200,000, and they get $800,000 after that. So in that example, the first level of tax is the tax that Walmart paid, and then, which again was a $300 million on the $1 billion of earnings. And then the owner had to pay $200,000 for the dividends, okay, which the rates there was a preferential rate, but it can be ordinary if it's some other form of distribution, or depending on the year, because in the past, it's been, dividends were subject to ordinary income rates, and at the time of this video, they're subject to preferential rates. In the future, they could change. So that is the second level of tax. That is on the dividend or the distribution. So I hope that clears up that issue. And I know some of you out there like, I knew exactly where the double tax is, but I wanted to make sure that everyone's on that level, because we're going to next talk about the effect of the Tax Cuts and Jobs Act. And before we talk about the actual updates from the Tax Cuts and Jobs Act of 2017, which has changed the corporate landscape and other business entity landscape immensely with respect to tax planning, it's really important to understand this double tax. Now, just one element I want to add on is that if you have a corporation that owns another corporation, there actually can be 3 levels of tax, or there will be, usually. Why? Because the corporation that is owned by the other corporation pays tax at its level. Then a distribution, so this corporation, we'll say Corporation A owns Corporation B. Okay? And let's say that Corporation A owns 50% of Corporation B. So Corporation B is taxed on its income and then distributes the remaining portion out to the Corporation A. Corporation A is then subject to pay tax on that portion, and then its owners are subject to a third level of taxation, which we see here. Now, one way to alleviate this, which there's a video on this discussion, is what we call the dividend dividends received deduction, or the DRD for short. Not like the game, right? Not dance answer, not that game out there, the dancing game or whatever. Dividend received deduction. All right. Dividend received deduction, and that's a way to alleviate that triple taxation in that example. It's based on how much ownership A has in B, and it basically excludes a portion of those dividends out there. All right, so this is going to be really important to understand for the other topics, that double taxation element. So now we've talked about a bunch of different things, the history, we've talked about how the corporate tax is a separate tax, double tax, and you're probably wondering, well, aside from non-tax reasons, like maybe you need capital or, maybe investors, venture capitalists require that you operate through a C corporation, why would anybody ever operate through a corporation, mainly a C corporation, right? I'm going to differentiate C corporation, S corporation here in a moment, but through a C corporation, right, which has a double taxation. Why would anybody ever operate through a C corporation in our past history and looking forward? So the first thing I want to talk about, this is really where we talk about the Tax Cuts and Jobs Act of 2017 and in the future and how things are affected. This is 2018, the time of this video. You might be watching this plenty in the future, so things may have changed. But, this is important to understand, because it talks about our history. It talks about, the idea of the Tax Cuts and Jobs Act, where it was meant to go for a historical view if you're looking, watching this any time in the future from 2018. So we saw, and when we looked at our history, we saw from the codification, the second codification of the Internal Revenue Code in 1954 to 1986, we saw two things that we can isolate from that discussion. We saw corporate tax rates that were between 40 and 50%, and we saw individual ordinary income highest rate, right, between 70 to 90%. So between 1954 to 1986, and one thing to note is that if you use a partnership, so the 1954 tax code, that really is where the subchapter K for partnerships came about, where we learned, okay, it's going to be treated as a pass-through. That's really where that area, that partnership tax law came from. So the idea for pass-through entities like sole proprietorships, partnerships, and today LLCs is the income passes through to the actual owners, and it's taxed at the individual owner level. And that's an allocation, not a distribution. Very important to understand. Allocation, which means that on paper, it's going to be allocated out, versus distribution actually is going to be transferred out to the shareholder. Okay? So between 1954 to 1986, we have this issue where corporate tax rates are much lower than the highest individual tax rate is. So what a lot of people were doing is they were using closely held C corporations. They were using closely held C corps to basically put in or conduct all their business, or most of their business. And they were taxed at, let's say, the highest rate of 50% rather than being taxed at 80 or 90%. So you're saving potentially around 40% in taxes by doing that. And this is before LLCs were a thing and S corporations, just so you know. And even so, they'd be taxed, a lot of the items would be taxed as at ordinary rates, so why would you do that? Well, then we have our Tax Code 1986, which effectively really comes in around 1987, and what it does is corporate tax rates are, the highest rate is around 35%. We'll just say 35% because I'm saying from 1987 to 2017. And individual tax rates, well, in 1987 actually were 28%, so we'll say 28 to 40%. So really, during most of this time, the individual tax rates are either less than or equal to the corporate tax rates. Now, there's a few years where, okay, yeah, there's a 5% difference, but with the double taxation, why would you do that? Especially given that you have pass-throughs. This is also a time where LLCs and S corporations become very popular. From a Well, S corporations for a tax standpoint, LLCs from a tax standpoint as well, but also a legal standpoint as well. Now, S corporations really came about in the late 50s, early 60s, and they didn't really catch on to 70s and 80s, where you where you have this change in the tax law. And the idea is that S corporations, which stand for small business corporations, really it's the same thing as a C corporation for legal purposes. It's just you make an election for federal tax purposes. So the only difference between a C and an S corp is that S corp has an election for tax purposes. The only difference. So you save potentially a lot in taxes because there's no double tax. It's a pass-through entity. So from 1987 to 2017, LLCs and S corporations, they dominated, especially towards the end of that time. They dominated the area of choice of entity. So again, we go from closely held C corps to LLCs and S corps. So 2018 to the future. Really, let's talk about the Tax Cuts and Jobs Act. So the TCJA. So there was many items that, many goals of the Tax Cuts and Jobs Act. It was supposed to be thought of as major reform, which some areas were major reform. Mainly, international tax did have as close to anything to reform. Now, a lot of the Tax Cuts and Jobs Act items were driven by international aspects. Our society is becoming more and more global. Globalization. We have to look at things we have to compete with other countries. We're no longer, the top country as we were in the 1950s and 1980s, back when we were one of the top countries with respect to GDP economically. In the 1980s to 2017, we slowly saw some of the Asian countries and other developed countries start to get either above us in GDP and economic growth or close. And then finally, in 2018, we started, we have a lot of companies that are going offshore because there's all sorts of benefits, not only tax, but other reasons why they're taking their headquarters from the U.S. and going offshore to other countries. So the Tax Cuts and Jobs Act of 2017, the TCJA, really focused on international. It looked at the OECD countries. The OECD countries, and it said, okay, well, our tax rate in 2017, our corporate tax rate was 35%, highest rate. The average highest rate for OECD countries was around 22 to 23%. So one of the major goals of the Tax Cuts and Jobs Act was to get that 35% rate down to 15 to 25% to be competitive against these other countries. So we could incentivize some companies not to, go again offshore. Now, whether you agree, that's actually going to, benefit or actually do what it's supposed to do or what it actually did is another thing. But that's kind of one of the major items. And you can see that because when you look at a lot of the provisions in the Tax Cuts and Jobs Act, a lot of them are temporary, but the actual corporate tax lowering to 21% was a permanent change. So that is what happened. In the Tax Cuts and Jobs Act of 2017, the corporate tax rate is 21%. Now, the highest individual rate is 37%. As of 2018. Okay? So as of 2018, we have individual rate 37, corporation rate of 21. And by the way, the Tax Cuts and Jobs Act, the corporate rate is a flat 21%. There no longer is the progressive structure that we used to have with the corporate tax system where you have a lower rate and then you have a higher rate with more income. So 2018, the highest individual rate is 37% and the C corporation tax rate is 21%. So this is kind of looking like this right here, where back from 1954 to 1986, the corporate tax rates were lower than the individual, the highest rate. Well, there's a few things to consider though. With double taxation, if you're at the 21% rate, effectively you're just under 37%. So you're still under that, but you do have the benefit of timing because you can keep your operations if you don't make any distributions and not be subject to double tax. Now that's again, or that's not considering the effect of the accumulated earnings tax or personal holding company tax, all those different things. So you gotta take into account those things, but you might be able to do that. However, or there's another thing that came into place because a lot of those people in Treasury, IRS and Treasury, knew about, they've been around back in the 80s, and they knew, okay, closely held C corporations were the vehicle used back when we had this issue. They said, okay, well, the LLCs and S corps, the pass-throughs, we need some type, including sole proprietorships, we need some type of measure that doesn't create this situation where everyone flocks to the C corporations like was done in the past. So the pass-throughs now have a special deduction. It's the first time ever, called the Qualified Business Income Deduction, QBID, which effectively, if you get the maximum amount, is going to be 20% of your QBID if you qualify. Qualified business income, not QBID. 20% of your qualified business income will be a deduction. A deduction that you get to offset. And that's going to apply it does not apply to C corporations, but it applies to LLCs, S corps, and sole proprietorships, any pass-through entities. Even trusts and estates can effectively get this. So the question becomes, back in 1987 to 2017, the question when you were looking at business entity planning, you're looking at C corporations, S corporations, and LLCs. Very rarely would you want to start your business as a C corporation, for many reasons, but mainly because of double tax. Why would you do that? I mean, there were some reasons to do it. So the first question that a lot of people would ask is, should we be a C corporation? Does it make sense? Because if not, then it's between LLC and S corp, because there are some differences between the two. Flexibility, employment tax, those kind of things. So with the C corporation, it was very rare to use this entity in 1987 2017, unless, again, you need it for financing, venture capital purposes, those types of things. Now, in 2018, with the C corporation rate reduced, the C corporation does look a little more enticing, but there is this qualified business income. Now, you have to look, it's going to become, the tax entity planning isn't simply just, oh, does a C corporation make sense? It's going to be, you have to look at the specific business. Now, because this qualified business income deduction is so much based on the type of business you have, whether it's service versus general, and other limitations as well, if you have wages or you have property, it's going to become more of we have to drill down and narrow down the actual business. It's not a general. The approach isn't as general as it used to be for eliminating C corporations. A C corporation might be the best avenue here, because if your business entity is not going to get that qualified business income deduction, the C corporation, even with double tax, could potentially have a lower rate. And again, with the timing aspects, could be a huge benefit. So really, my point here is to show you the Tax Cuts and Jobs Act of 2017 has really brought life back to the C corporation, the use of it when it comes to smaller businesses, closely held. Obviously, if it's a huge business like Walmart or a publicly traded business, or other publicly traded businesses, you gotta go through the C corporation, but that's from a non-tax standpoint. But now the C corporation jumps back into the arena when it comes to tax planning. So this is a really interesting topic. Think about this whenever you're thinking about corporate tax. So the next topic is classifying the arrangement. What we're talking about here is, do we actually fall as a corporation for federal tax purposes? Now, many of you know that a corporation is determined under state law, whether you have a corporation or you don't. But the federal income tax is a federal aspect. So we actually have to look at the definition of corporation and whether we actually fall under the corporate tax rules regarding our entity. So it's even possible to have an entity even though you don't have an entity for state law purposes or local law purposes. Now, one thing I want to note is that I have another video called A Checklist for Classifying a Partnership for Federal Tax. That's the title of the video. Please find that. That video goes into this even more depth. The reason why I'm referring you to that video is because that one goes into some more advanced topics. This one's just a general discussion, and this actually does lead you to what we call per se corporation rules or election of corporate treatment for federal tax purposes. So please do watch that video if you get a chance. So to classify an arrangement, which again will lead us to whether you're subject to the corporate tax rules, we first must determine if there's an entity. So it's possible even to have some type of contractual relationship where you don't have an entity for state law or local law purposes. You can have an entity for federal tax purposes. Again, the video goes into some issues there with respect to that whether you actually do have an entity, even if you haven't. Now, obviously, if you have an entity for state law purposes, you continue. Or if you have an entity under the classification from the law, then you have to continue. But if you don't have an entity, you can stop. So if you have an entity, so if there's no entity under the first consideration, we stop, and you're not going to be considered a corporation. It's most likely just going to be treated as sole proprietorship, Schedule C activity based on the type of activity. If it's a business versus it could be rental activity, right? And then could be, you have to look at whether it's investment versus business. That's why I'm saying it really depends even beyond that. But we don't have a corporation. Next, once we have an entity under the law, we then have to distinguish trusts. So if we do have a trust, if we have a trust, we stop. If we do not have a trust, we continue. If we're not a trust, then the next thing we do is we have to classify the entity. And this is where specifically you can have a per se corporation. And the law actually defines this. And again, the video goes into this in more detail. But really, the main types of per se corporations, if you have a corporation under state law, state or local law, so state law, you have a corporation, or international. An international equivalent is treated as a corporation, a per se, which means if you have a per se corporation, you're not going to be able to elect. You're not going to be able to check the box and treat that corporation as a disregarded entity if you have one owner, or a partnership if you have more than one owner. And it gives you a single treatment. Okay? Now you can still potentially get S corporation status, but we're talking about right now, you are a per se corporation. You can't get out. So again, the big one is that if you are a corporation under state law, you are going to be per se. There's again some other things, international and other aspects, but per se corporations, you have to stop and you are treated as a corporation. Now, if you're an eligible entity, which means that you're not a per se corporation, under number 3, you're eligible, which means you can check the box, or if you don't check the box, you're the default. Now, if you're a partnership for tax purposes, you can check the box and be treated as a corporation. Same thing with disregarded entities. If you make it this far, you can check the box and be treated as a corporation. Now, why would anyone want to do that? There are some benefits if you're an LLC for local law, state law purposes, but you elect to be treated as a corporation, and then you file an S election. Mainly the self-employment rules. That's where you can find some interesting maneuvers there where they do that. If you don't check the box, the default is always the single level of tax. No double tax, meaning if you only have one owner, you're a disregarded entity. So like a single member LLC, one owner, you're going to be treated as disregarded, just like a Schedule C, disregarded flow through with the sole proprietorship. If you have more than one owner, you're treated as a partnership and you're subject to subchapter K with respect to those items. All right, again, I want to highlight, please go watch that checklist for classifying a partnership for federal tax. Yes, it deals with partnership tax, but there is a discussion about corporations which lends itself to this, and it actually gets you to that point. It goes in much more detail. All right, so now we finally have arrived at our last topic, which is calculation of the corporate income tax. We've talked about the corporate tax history with regard to, we talked about rates. We talked about how the corporate tax is a separate tax. We talked about the double tax regime, which is a huge nightmare, but it's been overcome in the past. We've talked about the Tax Cuts and Jobs Act, as well as the history with respect to tax planning. We've talked about classifying an arrangement. Finally, the last thing is calculation of the corporate income tax. If you know that your business entity is subject to the corporate income tax, how exactly is it calculated? And I highly recommend at this point, you stop the video and either you pull out an internal revenue code, maybe you have a condensed internal revenue code, or at least go onto the Law Cornell site and look at the actual table of contents. Because one of the things that really helps you understand how the corporate income tax is calculated is really focusing on the table of contents. Now, this video is not meant to be in any way an advanced discussion of every single detail with respect to calculating the corporate income tax. I have other videos that deal with the consequences on formation, distributions, all those things. This is really meant to go through and look at the individual income tax formula, which a lot of you are probably familiar with how to calculate the individual income tax, and really go through the code as well, the structure of the code, and show you what kind of things you need to consider when you're looking at the corporate tax, because some of those same rules flow over with respect to the corporate tax formula. So again, I highly recommend having some type of Internal Revenue Code handy, or at least opening up that site. So the first thing I want to focus on is the Internal Revenue Code, which we know is Title 26, and the corporate income tax is an income tax. So we have to go to Subtitle A of the Internal Revenue Code. Subtitle A deals with income tax. And this, you can find individual income tax, partnership. You can deal with any type of income tax that we know about. But Subtitle A is separate from the estate and gift tax, for example, which deals with a non-income tax item. Okay? So Subtitle A deals with income tax. So next we're going to be focusing on Chapter 1 of Subtitle A, which deals with normal taxes. Normal taxes. And again, same idea. The rules for individuals, you'll find almost all of those rules under Chapter 1 when you're talking about the income tax. So Chapter 1. And then finally, specifically dealing with the corporation, there's a special set. It's called Subchapter C. So when you hear we have C corporations and S corporations. Well, Subchapter C of the Internal Revenue Code is where we get that C corporation from. Subchapter C deals that only applies to corporations. So the idea here is that if you have a corporation, Subchapter C applies, as well as other subchapters, but no other entity is subject to Subchapter C. That's the idea. So the next thing I want to do is I want to just talk about, again, I have my code here, and I'm looking at Chapter 1, which is normal taxes and surtaxes, and I'm looking at all the subchapters. Determination of tax liability, which is A. B is computation of taxable income. C is corporate distributions and adjustments. Subchapter C, again, is where the special rules are for corporations, but you still have to start with Subchapter A, determination of tax liability. So the point is that not all rules for calculating the corporate income tax are found in Subchapter C. You got to look elsewhere, and a lot of that has to do with Subchapter A and Subchapter B. Now, Subchapter A is titled Determination of Tax Liability, and this really deals with Sections 1 through Section 61 of the Internal Revenue Code, just so you know, or at least at the time this video is taking place. And so we're talking about the tax rates as well as the credits and the alternative minimum tax. Those are all out there. And we actually find the tax rates under Section 11. So Section 1 deals with individuals and the tax rates on individuals. Section 11 deals with the tax rates on corporations. All right, on corporations. So there's a special provision that provides that. So then once you get through the tax rate, Section 11 for corporations, we then jump to the next part, which deals with credits. So Sections 21 through right before the AMT rules deal with credits, and you'll notice that some of these credits in these provisions, 21 through about 54, some credits apply to corporations, other credits do not apply to corporations and only apply to individuals. So it's really important to understand that. Okay, very important. So going through the credits, and then we get to the AMT. So for a long time, corporations were subject to the alternative minimum tax. Now, at the time of this video, the alternative minimum tax is no longer applicable to corporations. That's part of the Tax Cuts and Jobs Act of 2017. That's a big thing. Once we get through the AMT, next we go to Subchapter B of Chapter 1, Subtitle A, which deals with computing taxable income. And the first item that we have there is gross income defined. And you'll notice that if you're looking here on the left, the individual income tax formula starts by saying we start with gross income. And that's going to be the same for the corporate tax formula. That's going to flow over. So the first item for the corporate tax formula is also gross income. And Section 61 also determines gross income for the corporation as well. So those rules that you learned in that individual income tax class are going to become very beneficial in this class, or this topic, I should say, for corporate tax as well. We continue through, and you notice the next provision is Section 62, adjusted gross income defined. Well, I'm going to go ahead and give you the bad news, but some of you probably don't really care. There is no adjusted gross income for a corporation. A corporation calculates taxable income by taking gross income minus deductions. Minus deductions. There is no difference between above and below the line deductions with respect to a corporation, and that gives taxable income. That gives taxable income. Now, remember, for individuals, we have above the line deductions, we have below the line deductions, which we also refer to as itemized deductions. Now, the Tax Cut and Jobs Act really affected a lot of those deductions, so you need to pay careful attention. But the idea is that there's no adjusted gross income with respect to the corporation. There's no adjusted gross income with respect to a corporation. That's an individual item. There's also no personal exemptions, and there's no standard deduction for a corporation. So it's simply gross income minus deductions equals taxable income. And that's clear by reading through Section 62, 63, when you're talking about the standard deduction. So we continue on the ordinary and capital discussions, or there's ordinary provisions and whatnot in the 60s. Those also apply to corporations as well. All right. We continue, and then we go to Section 71, which says starts the items specifically including gross income. So really, starting with Section 71 through Section 99, we're talking about items that are excluded from gross income, and these apply both to individuals and to corporations. Now, some of these you're going to say, well, it's impossible. Alimony. A corporation can't get alimony or pay alimony. That's correct. But what about annuities? The annuity rules. A corporation can get paid an annuity. So under Section 72, we would apply those rules for annuities. All right? That's an example of a provision that applies both to corporations and individuals. So we continue, and again, you want to be looking for these various provisions in that 71 through 99. Then we get to Section 101, which starts the items specifically excluded from gross income. We have life insurance contracts. Look at that Section 101. 102 is gifts, but I want to focus on Section 103, interest on state and local bonds. This is a big one. Tax-exempt interest. Tax-exempt interest is excluded for both individuals and corporations. Now we continue through the 101s, or the 100s, 101 to about in the 130s. And then one thing I will go to is, and I'm skipping over the private activity stuff of 141, the tax exemption for state and local bonds. That's obviously something you need to look at. But if you go into 151, it talks about personal exemptions. Personal exemptions are not for corporations, and it specifically deals with that in Section 151. Now, at the time of this video, personal exemptions still exist for individuals, but the amount is actually zero starting in year 2018. That amount can change in the future, so please pay attention to that. But a corporation does not get a personal exemption. So we continue on through the 150s, talking about personal exemptions, dependency. Then we get to the 160s, which starts the itemized deductions for individuals and corporations. It says specifically for individuals and corporations. So I want to focus on Section 162, trade or business expenses. So 162, which is the bread and butter, big deduction out there, where you have ordinary, necessary, paid or incurred during the taxable year in carrying on any trade or business. This applies to individuals and corporations. This is where a lot of the deductions like rental, compensation, corporations can deduct these. So you got to go through that same Section 162 analysis when you're dealing with deductions for the corporation. So we have 162, trade or business. 163 deals with interest. And there's actually been some change with interest with respect to corporations with the 163J rules from the Tax Cuts and Jobs Act. So make sure you focus on that. 164 deals with taxes, so any taxes that are paid, state and local mainly. 165 deals with deductions of losses, very important for corporations. We continue. 166 is bad debt. 167 depreciation. right? Corporations can deduct depreciation, as well as 168 provides more rules for depreciation. We continue on. 170, charitable contributions. Charitable contributions, this is big, right? Corporations can get a deduction for charitable contributions. They do have different rules than individuals, but they can get it. 171, continuing on some very specific provisions. 174 is a big one for corporations, and 172. 172 is net operating loss, which has special rules for individuals versus corporations. And 174 is research and experimental. So the point is that 162 through the 199 provisions, they apply to both individuals and corporations. 179 with respect to recovering various items. And you continue all the way through, and you'll find 195, well, there's actually a provision for corporations in the 200s. So it's important to go through those things, through the 162 through the 199 provisions. Then when you go to the next page, you start seeing that additional itemized deductions. This is where corporations can get, so there's section 211 through those provisions. Corporations can't get that. Okay. Now, the deduction limitations, they put limitations on in the 250s and 260s, the 260s and 270s. Those provisions also apply to corporations, so you got to pay attention to that as well. And 280s, and the 280s. Finally, we get to the 300s, and that's where we see subchapter C. So subchapter C provides special rules with respect to only corporations. Mainly what we're talking about here is special things like formation, contribution, distributions, liquidation, reorganization, special rules that apply, and that's in subchapter C. Now also, all the property transaction rules that I'm sure you're familiar with respect to individuals, like when you sell capital assets, 1231, depreciation recapture, all that stuff applies. So that's like in the section 1000s and the 1200s. All that stuff applies to corporations as well. So the point is that you can't just forget all your individual stuff. You got to remember that stuff for corporations, because a lot of those provisions apply across the board to individuals, corporations, and other types of taxpayers as well. So again, to get taxable income for the corporation, we have gross income minus deductions with no distinction for above and below the line. There's no personal exemption, no standard deduction. After that, the corporation then is going to multiply times the tax rate, which, remember, corporations have different tax rate structures than individuals, and there's also no preferential rates. So for an individual, the tax rate could be different. Different percentages for different character. Right? You can have some long-term capital gain or loss, some 1231, get that preferential rate, some dividends. At the time of the video, different dividends have a special rate. They might not in the future. They didn't in the past. So different percentages for different characters. For a corporation, there is no distinction. It's the same tax rate. At the time of this video, 2018, it's going to be 21%. Then we get our tax liability for the corporation. And after this amount, corporations do have plus or minus for credits and other items. But again, there's no more AMT at the time of this video. There was no more corporate AMT. That's a big thing. And again, not all credits are going to be the same. Not all credits are going to be the same. And that gives us our tax due or refund depending on the situation. But again, I want to focus, look how similar the individual income tax formula is to the corporate tax formula. It's very similar, except again, there's just not the characterization and the special items. So we still have our taxable income item and our tax rate, right? And our deductions come from all of this right here, right? There is just no distinction in the deductions above versus below the line. We still have our credits. We still have a tax rate, but it is a different tax rate. It's just, it's not as broken out, and we still have a tax due and tax refund, just like we do with the individual tax. So I really hope that this video helps you understand the general framework of the corporate tax, and this is supposed to be an introduction. Now, to dive deeper into various issues like distributions, reorganization, formation, watch some of the other videos because there's various topics, and these topics can get very complex. But my videos will help you organize those ideas and make it a lot more simple.